Welcome to the long and short of the markets. I'm Daniel Schwartzman. I did this for the first time last week, and I talked about how the markets had a bad October. Conveniently enough, in the week that follows, the market had its best week of the year. The S&P 500 was up almost 6%, the NASDAQ was up more than 6%, and the Russell 2000, which follows small caps, was up 7.6%. Huge returns. Mostly, as a lot of times, market participants can point to interest rates as the reason. Specifically, the belief that interest rates might not be going any higher. The Fed didn't raise rates, which was expected, but also market participants walked away thinking that the Fed won't raise rates again. And that's in part because the jobs report wasn't amazing. It wasn't bad. Jobs growth continued yet again, but it was lower than expected. And the other inflation metrics that are in the jobs report seemed okay. It was called a Goldilocks report, not foreboding ill for the market, but also not being so hot that the Fed would need to continue to raise rates. That's essentially what happened. Markets were already rebounding in the start of the week, but they continued to shoot higher through the end of the week, thus the ending numbers. I don't have a strong opinion about any of this, and I think this is a reminder of the sharp fluctuations that will happen from month to month and the week to week even, and the quick change in narrative that will happen. The market basically returned to where it was on the S&P 500, at least in the middle of October. So we went down for 9 days, we went up for 5 days. We'll see where we go next. We'll see where interest rates go. The narrative will change quite rapidly. It's worth spending a couple seconds to understand what's happening, but probably not much more than that. That said, there was a very interesting report amidst earnings, which is happening right now, and which I think generally is more interesting. There was one specific report that also lends a lot of insight into the macroeconomy. That's Berkshire Hathaway's earnings report. Berkshire Hathaway is, of course, Warren Buffett's company, and its earnings are interesting in its own way, even if you don't follow the company specifically, for a number of reasons. There are three things that I think make it different from most earnings reports. One is trivial. It reports earnings on Saturday, ostensibly so shareholders can review the reports without worrying about how the shares are going to move that day, since they won't move until Monday when the market reopens. But then also, because Berkshire Hathaway is not just a huge company, but it's a conglomerate. It has businesses in a variety of different industries, ranging from industrial businesses to railroads, to consumer businesses like Dairy Queen or Fruit of the Loom. Really, almost any part of the economy, Berkshire has a stake in it. Its reports will then give you light on each of those different industries, which I think is really interesting. Lastly, Berkshire is run by Warren Buffett as well as Charlie Munger, two of the most famous, most successful, and most interesting and thoughtful investors of the modern era. That plays out in their reports, in that their reports are written with the investor and the shareholder in mind in a more aggressive way, I would say, or a more open way, I would say, than a lot of companies. It's not that they're giving away a lot of secrets in those reports, but they do give us a lot of insights that are useful to understanding what's happening at the business. But because the business is so varied and so wide-spanning, what's happening in the US economy. With all that said, I would like to talk about three things that stood out for me from Berkshire Hathaway's Q3 2023 report, as well as one other general point from Berkshire's reports that I think is worth noting on. Let's go into it. On a headline basis, Berkshire's report was really strong. Its operating earnings have grown 19% for the first 9 months of 2023 and 41% in Q3. That's a difference of $3.1 billion in those 3 months. That seems like a huge amount, a huge swing from what was already a pretty profitable 2022. Amazing, right? Well, I don't want to put words in your mouth, and I think there's an important piece of context, which is that all of the swing in profitability, the improvement in profitability, can be attributed to Berkshire's insurance business. Berkshire owns several insurance businesses. That was Berkshire's first real business once it shifted after Warren Buffett purchased it in the 60s. And the insurance business is what Berkshire is best known for. Specifically, 77% of that shift was at GEICO. GEICO, of course, is the auto insurer. You know it for the Gecko, Hump Day, and so on, all the commercials. GEICO's auto insurance business has been a lag for Berkshire for a lot of 2022. It was a money loser. And in 2023, it's shifted to a money gainer, more and more in each quarter. What's going on? Most obviously, GEICO raised its premiums quite a bit. The premiums on its auto policies on an average basis grew 17% in price in the last 12 months. Why did they raise the prices so much? Because the auto insurance industry has really been struggling with the high cost of repairing cars over the last 18, 24 months or thereabouts. Inflation has been a real problem. It becomes more expensive to repair cars after they get totaled in an accident, which is what an insurer has to do. And thus, the insurers are losing money because their policies were priced at a lower rate. There's a further element of COVID happened and a lot of people didn't drive. And so auto insurers made a lot of money because people weren't getting into accidents without driving. They started driving again. Accident frequency also went up quite a bit in the first year or two after the extreme part of the pandemic. But the severity of the accidents and how much it cost the insurers to pay for those accidents, that was the real problem. GEICO raised its rates a lot. As a result, its policies in force declined quite a bit, over 12%. So they have fewer customers at a higher rate, and they're able to make more money. It seems like they've gotten a handle on the inflation. That could mean that we're going to see less increase in auto insurance rates going forward. And this is an example of where we could see the end of inflation. But there are some notes of caution in the report. GEICO, or Berkshire Hathaway, noted that auto claims severity, how much it costs them to pay for accidents, is still increasing in 2023. And recently we saw big news, the successful United Auto Workers strike against the big three automakers in the US. That is over, but that would have slowed production for 6 to 8 weeks. That could have an impact on auto prices. And we'll continue to see what happens in terms of inflation and whether it becomes more expensive to repair autos. This is the real tension. It's a real good microcosm of the inflation challenge. Why economists will often worry about an inflation price spiral. As prices go up for everything, workers demand better wages, which then leads to more price inflation. And if we can't get a handle on something like the cost of repairing autos, we could see this continue to cycle. We'll see. GEICO's reports suggest that they're able to get a handle on it. There's one other interesting comparison here, because there are other auto insurers. The biggest one is Progressive, which is a big competitor with GEICO, and they look at each other very closely. Progressive is also raising their rates, and they're also have seen a lot of challenges with the severity of auto claims. They also had a good Q3, and the difference between Progressive and GEICO is that Progressive is less profitable right now on its auto insurance. Its profitability ratios are worse than GEICO's this year, but it is growing its premium, or the number of policies it has. It's grown it by 10% this year, 2.8 million more policies in force, whereas GEICO has decreased by 2.3 million. All of which is to say we're seeing two different strategies playing out, and it'll be interesting to see where this goes depending on what happens and whether or not we've turned a corner on inflation in auto repairs. All in all, this is just an interesting microcosm into inflation, and it explains where Berkshire's business, even though on a headline basis it has grown quite a lot, it's because of essentially solving a couple specific issues. GEICO and its auto insurance, and then there have been fewer natural disasters, which means that the rest of its insurance business has been able to hold out pretty well this year and have more profitability. If Berkshire's insurance business is the entire reason why its earnings have grown so far this year, then the rest of its businesses are presumably flat for the year. And when we look under the hood at these different business lines, we get interesting insights about the economy as a whole. Berkshire's railroad business, Burlington North Santa Fe, has seen earnings decline. They mostly attribute that to less volume, less demand for their railroad services, less demand to ship stuff in the rails across the country. And when they dig further, they say this is mostly due to less demand for plastics, for chemicals, for lumber, for sand. But they do see some positive demand for construction products, which is related to infrastructure. Of course, the US government Joe Biden's administration and Congress passed a couple bills in the last few years to invest in infrastructure. There's the Inflation Reduction Act, and then there's the infrastructure bill, which was bipartisan, both investing in infrastructure, which could end up being an interesting example of Keynesian economics, of the public sector stepping in as the private sector diminishes in demand, keep the economy going and keep people employed. We'll see if that actually plays out, but it is an interesting example of the sort of on the one hand, on the other hand, which we see a lot in Berkshire's report. We can also see that in its building products business line, which includes businesses such as Clayton Homes, Benjamin Moore, a paint seller or paint manufacturer, Shaw, which does flooring, and so on. There are other businesses in this line. What Berkshire says here is that we're seeing a decline in demand, a decline in revenue, a decline in earnings, not surprisingly, because mortgage rates have gone up so much as interest rates have gone up so much. That dampens demand. They do say while they continue to expect lower earnings next year in 2024, they are seeing some positive demand from new construction, which is due to the fact that we need more houses in the US. We need more homes. Again, this is a one hand on the other hand. It all nets out negative for Berkshire Hathaway's growth, but there is still the need for us to continue to grow housing stock, which will at some point play out in the economy as a tension against high mortgage rates. On the one hand, on the other hand. The more positive piece that I noted from Berkshire's earnings reports, again, from their wide array of businesses, was in their industrial products business, specifically precision cast parts, which makes parts for planes. It was a company that Berkshire bought to some controversy in the mid 2010s. They were accused of buying precision cast parts at a low price, at an unfair bargain price, an anomaly. But it had been a poor performer for Berkshire for some time. So even if they bought it at a bargain, it didn't work out very well for Berkshire for several years. That said, this year it's been doing really well. 26% growth in revenue, 32% growth in earnings, and Berkshire cites continued demand and long-term expected demand for aerospace, for planes essentially, and for air travel, which would seem to accord with a good economy. If we have money, we want to travel, if we're able to spend on travel as a global economy, that probably suggests that the economy isn't going to fall off a cliff. That's a positive as contrast to some of the negatives I mentioned. Berkshire's industrial business and its consumer business, again, all of these businesses outside of insurance are essentially flat year over year. If you take 2022 and think that that was a decent year, then we're not at the end of the world, but we're not seeing continued growth, which is what we normally expect or we normally want from investments and from the economy as a whole. Something interesting to watch and a good insight that you can see from Berkshire's report. The last thing I'll call out from the report specifically, and it's one that I think a lot of investors will have to follow more than anything else, is how Berkshire Hathaway is investing. Because Warren Buffett is the most famous investor in the world, people watch any changes in Berkshire Hathaway's investing habits very closely. He is the primary person responsible for those decisions, though there are other investment managers at the firm who are independent in their decision making. That said, there are a couple things to watch for. First of all, Berkshire was again a net seller of stocks this quarter. It sold $5 billion plus in stocks as compared to how much it bought, meaning on a net basis, it sold $5 billion plus. That is less than it sold in the prior 2 quarters, but it's also the 4th straight quarter that Berkshire is a net seller of shares, which take it or leave it as far as how much that matters. Shares have gone up quite a lot. Equity markets have risen for the last 4 quarters. So that could just reflect the company is feeling like it can take profits on certain stocks. It could reflect some other distaste with the valuation for stocks out there. What Berkshire is buying is treasury bills. It bought a net $28 billion in treasury bills in Q3. That's a huge jump in the amount of bills it's buying. It's buying an enormous amount, and then they're coming due it very quickly because these are short-term treasury bonds, essentially from the U.S. government. They come due in 13 weeks or 26 weeks. Berkshire Hathaway is buying them. Why? Because they can get almost over 5% in annual returns from the interest rate. at basically zero risk. This is what is considered the most riskless asset out there on the market. That's just an example of the challenge that's posed to all of us as investors. If we can get the equivalent of 5% plus at no risk from the US government to buy anything else, we have to really feel like we have a great opportunity that is worth the higher risk, meaning that we need to see better returns than 5% and considerably better returns than 5%, given that we're taking on risk in any other investment in a way that we're not really taking on with treasury bills. Doesn't necessarily mean anything in and of itself, but it's interesting to watch. And it's interesting because it's an example of even the best investors in the world, like Warren Buffett and Charlie Munger, are willing to sit back and invest in something risk-free without taking any huge swings if they don't see something they like, which evidently is the case. It's okay to wait for your fat pitch, as Buffett always says, and we're seeing Berkshire Hathaway doing this right now. Doesn't mean that they'll swing successfully or that they'll swing at all in the months ahead, but it is worth watching and observing. The other thing that people are watching is that Berkshire Hathaway, how much did it buy back its own shares? Because it loves to buy back its own shares rather than paying a dividend to its shareholders. And in this case, the share buyback also slowed down in Q3. It went down to $1.1 billion in shares bought back by Berkshire Hathaway versus $5.8 billion in the first half of the year. So that's a more than 50% slowdown in the rate if you go on a quarter-to-quarter basis. Again, unclear what's actually happening here, whether this means that Berkshire thinks that its own shares are expensive, whether Buffett thinks that Berkshire's shares are expensive, or just felt that treasury bills are more attractive, or whatever else. I will say that Berkshire Hathaway's shares did outperform the market in Q3. They actually went higher while most of the market went lower. Could be that that's an issue on the margin. Could just be something else going on, but worth noting. Those are some of the takeaways. It seems that Berkshire Hathaway is cautious about investing in equities right now, but we'll see how that continues to play out and how much that actually means for us as individual investors. I did want to make one general point about Berkshire's report and how they report their earnings, because they like to report on an operating earnings basis, as I mentioned at the beginning. Operating earnings is distinct from net income, basically because Berkshire says, ignore all the gains and losses that we might have from our stocks, which we are required by generally accepted accounting principles, GAAP, to report as income, but we don't think it actually matters because that will fluctuate from quarter to quarter and is just not useful to investors in analyzing how our business is actually going. I mentioned GAAP. Companies are required to report on a GAAP basis in the US. It is the common language for accounting in the United States. Internationally, there's IFRS, which maybe I'll talk about some other time, but is a different accounting standard. Basically, they're just, here's how we handle this issue, that issue, and the other. Many companies like to adjust their GAAP results with a non-GAAP earnings number that takes out or adds certain things. It, for example, will often, in a company basis, they will often add back share-based compensation as an expense. They'll say, don't worry about that. That wasn't a cash expense. We're going to add that back to our earnings. I disagree with that treatment. I prefer to use GAAP earnings whenever I can because it is a common standard. It's the simplest standard. But I do think Berkshire Hathaway is an example of where you can use the non-GAAP number. You have to think about it. You have to decide whether it makes sense. And you have to keep in mind that as much as people admire Warren Buffett, he is a self-interested manager just like every CEO. And he wants to put Berkshire Hathaway in the best light. That said, he is consistent about always taking this out, whether it's good or bad for the company's earnings. After all, stock markets have gone up this year, so keeping those investment gains in would only help Berkshire's earnings this year, but they don't. They say focus on operating earnings. I think that makes sense, and I think it's worth, in your analysis of companies, considering when this does and doesn't make sense to use non-GAAP versus GAAP. Just keep in mind that as part of investing, we always have to think and put everything together and not get stuck on one or two things. You'll often hear that it's as useful to read Warren Buffett's annual shareholder letters and anything else he writes or any other interviews he gives as it is to get an MBA, that you get a business education just from reading Warren Buffett, which I can buy. I think he's a great communicator, and a lot of his reputation is built not just on his success, but also on his ability to communicate how he thinks and how he approaches the market. Berkshire Hathaway's quarterly and annual reports offer almost as much insight on the macroeconomy as you can get from reading the different headlines and reports that you get from the US government or from other data sources out there on what's happening in the market. It's a quarterly basis to understand what's happening, not just in all of these different businesses, ranging from consumer goods to RVs to home and house building to chemicals to airplanes and so on. And I didn't even mention insurance. It also is coming from the perspective of a business owner that has an interest in trying to make their business better and try to communicate to their shareholders how they're going about doing things. Again, they're not revealing secrets, but they're giving us here is how we think things are going to go, and here's how we're approaching certain things. For that reason, I think even if you don't have a stake in Berkshire Hathaway, and I do have one, it's worth looking at its report every quarter because you'll learn a lot about what's happening out there in the broader economy, and it might give you other investing ideas or insights for companies you might own. My name is Daniel. I am a short investing guide. I publish a short investing guide on this YouTube channel and have a website called shortinvestingguide.com. I've been doing this long and short of the markets for a couple weeks now, and will hope to continue to do this on a regular basis, maybe not every week. Subscribe to this channel if you enjoyed this. Leave a comment, get in touch, leave a like, and thank you for sticking it out this long. I hope to see you next time that I do this long and short, or on any of my longer term, more evergreen efforts to build out a short investing guide. Thanks for watching, and see you next time.